So, you want to own a laundromat. You find an empty building, fill it with washing machines, and let the customers do all the work while you just show up once a week to collect buckets of quarters. It is the ultimate internet dream, a recession-proof, fully automated passive income machine. But if you walk into any laundromat on a Sunday afternoon, you are not looking at a passive investment. You are looking at a heavy industrial utility business that requires constant capital, relentless maintenance, and a massive tolerance for stress. Today, we are going to tear down the math of the laundromat business. We will look at exactly what it costs to open the doors, the hidden expenses that bankrupt first-time owners, and why this passive business is actually a second full-time job. Let us start with this barrier to entry, because buying a few washing machines is the cheapest part of this equation. A standard commercial laundromat requires around 40 to 60 machines to generate enough volume to survive. A heavy-duty commercial washer costs between $1,500 and $4,000. The massive industrial dryers cost just as much. The equipment bill alone for a mid-sized operation easily hits $200,000 to $400,000. But the machines are useless without the infrastructure. A standard retail building is not designed to pump thousands of gallons of boiling water and vent massive amounts of hot, humid exhaust air every hour. You have to tear open the concrete floors to install custom plumbing trenches. You need industrial-grade gas lines and heavy electrical upgrades. This build-out can easily add another $200,000. And then comes the silent killer. Impact fees. Many cities charge a massive upfront tax just for the right to connect to their municipal water and sewer lines. Before a single customer washes a single shirt, you could be $500,000 in debt. Once you are open, the math shifts from capital expenses to operating expenses. A laundromat is essentially a business that buys water and gas at wholesale prices and sells it back to customers at retail prices. This means your utility bills are staggering. A busy laundromat can easily spend $3,000 to $8,000 every single month just on water, sewer, and natural gas. And if the city raises the water rates by 10%, your profit margin gets instantly crushed unless you physically walk around and change the pricing on 60 different machines. Then there is the rent. Because you installed $500,000 of permanent infrastructure into the concrete, you can never move. Your landlord knows this. When your lease is up for renewal, they have absolute leverage to raise your rent because you cannot afford to pack up your plumbing trenches and leave. Now we get to the human element. The internet promises that laundromats run themselves. The reality is that industrial machines break constantly. Zippers destroy dryer drums. Customers overload washers with heavy blankets, burning out the motors. When a machine is broken, it is not just a repair bill. It is zero revenue from that square footage until it is fixed. You either learn to do heavy mechanical repairs yourself in the middle of the night, or you pay $150 an hour for a specialized technician. And because laundromats are open late and often unstaffed, they become magnets for vandalism, loitering, and theft. The payment kiosks break, the plumbing backs up and floods the floor, and you are the one getting the phone call at 2 a.m. This is not passive. This is emergency property management. So let us look at the final math. If you survive the build-out, master the repairs, and keep the machine spinning, a successful mid-sized laundromat might generate a net profit margin of 20 to 30%. On $300,000 of gross revenue, you might take home $60,000 to $80,000 a year. It is a solid, honest business, but it requires $500,000 of capital and constant operational stress. Now, apply the owner mindset. What if you took that same initial capital, that $500,000, and instead of buying the laundromat, you bought shares in the massive utility monopolies that supply the water and the natural gas? What if you bought shares in the Canadian banks that issued the loan to the laundromat owner? You would collect a 4 to 6% dividend yield every single year, generating $25,000 in pure, truly passive cash flow. No broken pipes, no midnight phone calls, no dealing with the landlord. The laundromat owner works for the bank and the utility company. Stop trying to run the small business. and start owning the infrastructure. Build the bunker. Shields up.